In today's discussion, we're delving into the precarious situation many hedge funds find themselves in, teetering on the edge of liquidation. The recent market downturn, compounded by an aggressive doubling down on short positions in AMC and GameStop, has created a scenario where the survival of numerous hedge funds is in question. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads, and also enter our giveaway. But everyone, remember, this is not a financial advice video. An article has brought this critical issue into the spotlight, highlighting the alarming possibility that many hedge funds are merely a margin call away from a catastrophic collapse, reminiscent of the Archegos implosion. Kristen Shaughnessy brought attention to this article, asking a pertinent question. How many hedge funds are standing on the brink of an Archegos-style implosion? The truth is, we can't be entirely certain. Much like the unexpected demise of Archegos, it's plausible that tens, if not hundreds, of hedge funds could be in a similarly fragile position. The challenge in understanding the full scope of this issue lies in the limited transparency surrounding hedge fund borrowing practices and their intricate derivatives trading strategies. Without comprehensive insight into these operations, it's impossible to pinpoint exactly how many hedge funds are just a margin call away from disaster. The collapse of Archegos was triggered by a single stock, which saw a $3 billion sell-off, leading to a sharp decline in share price. This was enough to ignite a $20 billion liquidation frenzy, with banks offloading massive amounts of stock, including those of Viacom's and other major corporations, to cover the shortfall created by Archegos' collapse. Looking at the broader market, particularly the S&P 500 over the past few weeks, we can see a troubling pattern. The S&P 500 has broken downward out of its established channel, largely due to the unwinding of the Japan carry trade. This has resulted in a roughly 10% drop in the index over a short period, a drop that couldn't have come at a worse time for hedge funds. These institutions are currently carrying the most leverage they've ever had in the market. For hedge funds that are leveraged 2 times, 4 times, 7 times, or even up to 10 times, even a slight market decline can trigger devastating liquidations. If the S&P 500 fails to recover and continues its downward trajectory, we could witness a wave of hedge fund liquidations that would make the 2021 Archegos collapse seem like a minor event in comparison. This situation is particularly concerning given that hedge funds are not only heavily leveraged, but are also increasing their short positions on AMC and GameStop. However, these positions are not being taken directly in the stocks themselves, but through more complex means. For instance, short positions in ETFs that include AMC and GameStop have surged to new heights from 2021 through to 2024. The verifiable short data, while self-reported by the hedge funds, shows that direct short positions in GameStop have remained relatively steady. Yet, what's more telling is the rapid increase in short positions within ETFs holding these stocks. This indicates that while hedge funds may be trying to disguise their short positions on the individual stocks, they're unable to conceal the escalating short interest in the related ETFs. As a result, these hedge funds are becoming increasingly exposed to potential short squeezes in both AMC and GameStop. A recent tweet from kohrs, who used chat to analyze the situation, sheds light on the potential consequences for these heavily shorted stocks if the S&P 500 continues to decline. According to this analysis, the reaction of such stocks in a market crash could be extremely volatile. Factors such as high-frequency trading, the use of complex derivatives, naked short selling, and the potential for retail-driven short squeezes could lead to both sharp declines and unexpected, dramatic rebounds. This scenario is reminiscent of the historic Volkswagen short squeeze, where the stock initially plummeted along with the market, only to be followed by a massive squeeze that drove the price sky high. This historical context is important because it helps explain why hedge fund shorts and their allies in the mainstream media are now advising investors not to buy a AMC stock outright, but to purchase AMC options instead. This strategy appears to be a desperate attempt to lure retail investors into buying out-of-the-money options, which are highly risky and often expire worthless, thereby allowing hedge funds to pocket the premiums. This tactic is particularly relevant as the market has been on a downward trend, causing hedge funds to scramble for additional capital to meet their margin requirements and maintain their capital reserves. if their portfolios drop by several $billion. But they manage to extract a similar amount from retail investors through these risky options. They can offset their losses, at least temporarily. Interestingly, this comes at a time when GameStop is reportedly sitting on a significant amount of cash. According to a tweet from Kevin Malone, GameStop's most recent SEC filings reveal that the company has enough cash on hand to buy back the entire public float of its shares. This financial strength positions GameStop not only to perform share buybacks, but also to potentially reduce the float to such a small size that it could expose the underlying corruption in the market. Both GameStop and AMC are making significant strides as companies. They're reducing debt, building cash reserves, increasing revenues, cutting costs, and moving towards profitability. These developments suggest that these companies are on a solid path to long-term success, with continued growth expected year after year. As we look ahead to the third quarter, which runs through September, AMC is likely to report a record-breaking quarter, possibly hitting $2 billion in revenue by the end of August, with September still to come. This could set the stage for a $3 billion quarter, potentially the largest ever recorded in the box office industry. AMC, after a challenging second quarter, is now poised for what could be the best third and fourth quarters in its history. What's particularly telling is the recent move by Renaissance Technologies, one of the most successful hedge funds of all time. Renaissance has increased its position in AMC by 18%, as well as in GameStop. Renaissance first began purchasing shares back in 2021 and 2022, at prices over $300 per share, and has continued to accumulate more. Currently, Renaissance holds over 10 million shares of AMC. Known for its expertise in identifying market anomalies, Renaissance's continued investment in AMC suggests they anticipate a significant short squeeze, one that could spell the end for the shorts. Moreover, Renaissance isn't the only hedge fund doubling down on AMC. According to a tweet from Practical Stocks, AMC has recently attracted new institutional investors, including Mudrick Capital and Discovery Capital. Notably, Mudrick sold their shares just days before the June 2021 run-up, raising the possibility that if they sell again, it could precede another major squeeze. In conclusion, the current landscape for hedge funds, particularly those heavily involved in shorting AMC and GameStop, is fraught with risk. The potential for widespread liquidations, combined with the possibility of a massive short squeeze, makes this a critical time to watch the market closely. As these events unfold, the strategies and positions taken by key players like Renaissance Technologies will be crucial indicators of what's to come. Whether you're an investor or simply an observer, the coming weeks could be some of the most dramatic in recent financial history. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.